So today I wanted to speak about the safest asset class according to me and why now is a very good time to invest in these. They are nothing but gilt funds. Gilt funds are nothing but government or central government slash central reserve banks issued bonds in their respective currencies. For example, RBI issuing government bonds in Indian rupee. So why they are considered safest in almost all textbooks, economic and financial textbooks, is because the central banks can always print their way out of a sticky situation. So they are considered to have almost zero default risk according to most financial and economic textbooks. And now coming to the point why I consider them a very good investment asset class now, especially now, is because one, RBI has kept the repo rates unchanged for like four times, four meetings, right? That's almost a year now. And Federal Bank of the United States has also kept it steady for the second consecutive time, right? They kept it steady for more times, but in between they had hiked, right? So even though inflation is a slightly sticky point in the US, the inflation in India has reduced to 5%. And if you just Google search comfort levels of RBI, you will find it that it is 4% plus 2% margin, okay, or minus 2%. So currently it is within the 6% comfort margin of RBI, right? So I personally, my opinion, I don't find RBI to be increasing the interest rates, at least in the near future, unless the Federal Bank of the US increases their interest rates by a lot. Then RBI would be forced to increase the interest rate. But I don't think the Federal Reserve would be increasing it anytime soon. I think they would also be going for a rate cut, may go into a rate cut, not sure. But anyway, the scenario favors a rate cut, especially in the Indian scenario, right? So this is the Kuvera app, which I like. And I would, my favorite two gilt funds to invest are SBI Magnum Gilt Growth Direct Plan, right? And ICICI Prudential Gilt Growth Plan, right? Why I like SBI is because the drawdown is much lesser than ICICI Prudential, but the returns on ICICI Prudential is slightly higher. See, in SBI it was 8.1 and in ICICI Prudential it is 8.6, right? So this is what happened when the interest rates were kept steady. You a solid 8.6, which is more than the fixed deposit rates, right? Coming back to SBI Magnum, my favorite gilt fund is 8.1 and steady, right? And I was invested in both of these, that is SBI Magnum Gilt and ICICI Prudential, before I started investing on my own and in May, right? So these two were my two bread and butter asset classes. And one more benefit is most brokers consider gilt funds as cash component, right? So the haircut on these two mutual funds like 10%. So you can have a higher, what do you say, margin provided to you by the broker, and you can hold overnight also because it is considered a cash component. So that is one big advantage for these gilt funds. Right, now coming back to the fact why an interest rate cut could see these returns jumping from 8.1 to more than to double digits, right? And I really think that it would go above 10%. And historically speaking, it has given 15% as well. 15% on a zero credit risk asset class is crazy good. So this is what I wanted to show you. There in 2020, because of COVID, the government had started cutting the interest rates to improve economic activity, and as a result the gilt funds jumped to over 15% yields, right? So we could see something similar, double digits return, right, if the RBI reduces the interest rate. So another, I'll try to explain it as simple as possible. I'm not going into deep economics and all that, but if you look at the fund holdings, 7.1, 7.38, 7.06, 7.26, 7.3, 7.18, right? These are the holdings. Okay, so for example, this is like 100 rupees, right? Let's say 7.38 is valued at 100 rupees currently, and tomorrow RBI cuts the interest rates by 65 basis point or 0.65. People will want more of these 7.38 ones, right? Because the new ones, the new bonds that are released by the RBI would be at 6.75. Okay, 6.75. So why would someone buy 6.71 when you can buy 7.38? So there'll be more demand for these, and as a result the rates for these will go up. And just like a mutual fund, let's say, like, simply put, the NAV of all these will go up, the value of these will go up, and as a result of which the NAV will go up, and as a result of which your yield will go up, right? I hope you understood. So basically, if there's a rate cut, the older bonds would have a higher rate, and as a result of which the demand would go up, the prices go up, and as a result of which this value would go up. Let's say it goes up from 60 to higher. So basically, in simply put, your yield goes up, your returns go up, right? But there is always a risk. There is only one risk in gilt funds, that is interest rate risk. That is, if RBI decides to increase it by 0.25 basis points of 0.5 or 0.25, right? What happens is this percentage will go down. Why? Because your assets ka value will go down. So 7.38, let's say for example 7.38 is that available for 100 rupees, but the new bonds that are being released by RBI is coming at 7 point, let's say 0.5 percentage increase, it's coming at 7.8 or close to 8%. Why would someone buy your 7.38 ka bond? So the value 100 rupees, you will have to sell it at a discount. I hope you understood. When 8% bond is available on the market, that is RBI has increased the rate, why would anyone buy yours at 7.38? So you will if you want to find a buyer, you will have to sell it at a discount. But if you hold it till 2027, you will get this 7.38 ka return. Okay, but if you want to sell it immediately, you will have to sell it at a discount, because no buyer will buy yours, because 8% is available at the market. I hope you understood. So this is the only simple risk. I hope you keep that in mind. That is, if RBI increases the rates, this will go down. But I don't see that happening, because inflation has come down within RBI's comfort zone. And I only see a rate cut soon, and therefore a rate cut would definitely make these yields, that is 8% jump to double digits. I could make a double digit return on the safest asset class that is available in the markets, right? Which is the sovereign bond or gilt funds. So this is the best example. Gilt funds gave 15% in 2020, right? So if I were a safe investor, I would be investing a lot of gilt funds, right? If I were a safe, risk averse investor, I would consider this as a very good time to go in, invest a significant amount, because of the rate cutting cycle that is around the corner, according to me, right? So I would invest a big chunk of my portfolio into gilt funds, right? And my picks would be SBI Magnum gilt funds, one, and let's say I would put 75% in SBI gilt funds and 25% in ICICI gilt funds, because the drawdown for SBI is slightly lesser, and I think, if I remember correctly, vaguely, the drawdown including when the risk the rates were hiked, it was around 3%, 4%. I'm not sure. You need to do your due diligence, but I believe it was around 3% something, and ICICI was around 3.54% drawdown. Okay, so that's my opinion about gilt funds, and why I think this is a wonderful time to go heavy on gilts, right? Because 15% from a most safest asset class is so juicy, so juicy. right? But the only risk that is very significant that you should keep in mind is if the RBI rates increases the rates, then you can get you can get S dash dash dash, right? Okay. So yeah, do remember this is not financial advice. This is what I would do. This is just what I would do. This is just my opinion, and we are not SEBI registered advisors or financial analyst or anything. But with the little economics that I know, this is how I believe it things might play out. So yeah, do your own due diligence. I would say don't even listen to your financial advisor. Do your own diligence. Do your own research and take your own call and stick. If you make a call, stick to it and only invest the money you are willing to lose, right? So that's my disclaimer. So yeah, so that's about guilt funds, right? So bye. So hit the like and subscribe button if you enjoy this video and want more such experiments and more such opinions, right? Chalo, bye.